What if I told you the most important signal in finance is no longer coming from Wall Street? Retail clicks. Institutions allocate. The system reprices. There's a quiet regime change happening right now. For the first time, the stories of Bitcoin and gold are starting to align, reacting to the same global forces. But because Bitcoin is digital, it moves first. And if that's true, it's not just a Bitcoin story. It's a story about the repricing of everything you own, from stocks to homes to the currency measuring it all. We live in an era of non-stop intervention. When a crisis hits, central banks expand liquidity. We saw it after 2008. We saw it on a historic scale during the pandemic. And this creates the core problem savers face. When you increase the supply of currency, purchasing power erodes. This isn't a conspiracy, it's math. For generations, the traditional shelter has been gold, the original hard money, a store of value that can't be printed. But in the last decade, a new asset stepped onto the field, and it's changing the whole game. Here's the core idea. Bitcoin and gold are increasingly driven by the same macro fears. But because Bitcoin trades globally, digitally, and 24/7, it moves first. It's becoming a leading indicator for global liquidity. For years, the debate was, is Bitcoin risk on, like a tech stock, or risk off, like a store of value? The answer is becoming clearer. Bitcoin is evolving into a macro asset. When inflation fears rise, investors look for scarce assets. When the Fed hints at easing, investors anticipate cheaper money. And increasingly, both gold and Bitcoin react to those same catalysts. Why? Because they share two traits that matter in a world of debasement. Scarcity. Gold is hard to increase. Bitcoin is capped by design. Sovereign independence. They exist outside the traditional financial system, which makes them hedges not just against policy, but against systemic uncertainty. So the narrative solidifies. Bitcoin behaves more and more like digital gold. Not perfectly, not always, but more often than most people expected. If they react to the same forces, why does Bitcoin lead? Because Bitcoin is high beta gold. Gold is a cargo ship, slow, deep, stable. Bitcoin is a jet, fast, sensitive, instantly repriced. 3 reasons. Bitcoin never closes. It trades 24/7, worldwide, signals get priced immediately. Lower friction. Capital moves into Bitcoin faster than it can move into physical gold. Smaller market. Gold is deep and massive. Bitcoin is smaller, so flows move it more. That volatility isn't just chaos, it's an amplifier. Bitcoin doesn't just respond to liquidity shifts. It responds first, and often with more force. Here's the part most people miss. When Bitcoin rises in these regimes, it's not only Bitcoin getting stronger, it's the currency measuring it getting weaker. It's like your ruler shrinking. If your ruler shrinks, everything you measure looks like it's getting bigger. Our ruler is the dollar's purchasing power. And what shrinks the ruler? Liquidity expansion and falling real rates. Bitcoin tends to feel that shift first. And if Bitcoin is the fastest signal that the ruler is changing, then every other scarce asset eventually has to adjust just to keep its real value. Stocks, real estate, hard assets, everything. This isn't a price prediction. It's a framework for why assets move together. Quick note, if you want the full macro map behind this, Module 1 of my Macro Investing Masterclass is free in the description. It ties all of this together. Now let's keep going. Bitcoin and gold are no longer separate stories. They're increasingly two instruments responding to the same macro forces: scarcity, liquidity, and currency confidence. Gold is the anchor. Bitcoin is the accelerometer. And when Bitcoin starts trading like gold, the system reprices. Which raises the real question. If Bitcoin is becoming a macro hedge, why is the Fed willing to tolerate it? That's video 3.